Hi everyone, welcome to today's video. So let me start today's video by showing you the growth story of Hindustan Unilever in the last 1 month. In the last 1 month, the stock has given roughly 12.5% return, which is a fairly big gain considering the fact that the markets have been generally going down. Now, I have been making videos after videos on Hindustan Unilever explaining why it is one of my favorite stocks. I had been building my position in Hindustan Unilever like anything, and it comprises of a big position on my portfolio. Now, let me be honest and clear with you that I do not know when a stock is going to go up or down. No one can predict it. If people are telling you that, you know what, buy this, it is going to go up tomorrow, they are lying to you. Point number two, what I can do is that I can identify if an asset is good, if a business is good. And Hindustan Unilever, according to me, is a very good business. Third, what I can do is that I can easily figure out if something is overvalued or undervalued. So if you mix all these 3 points, what is the moral of the story that I'm trying to paint? The moral of the story is simple, that identify good stocks, buy them when they are undervalued, and reap benefits when they start giving a lot of returns. Now you will say that, okay, should I be buying Hindustan Unilever? Should I not be buying Hindustan Unilever now? I'm not going to give an answer on it because it becomes like a moral obligation that, okay, if I say yes to it right now, then from tomorrow it should start giving returns, which I can't promise. But on today's video, I'm going to speak about one stock in detail and explain you the logic, fundamentals behind it as to why I'm going to further build my position in this stock. I have already invested a lot of money in this particular stock. I'm going to almost double my position in this stock going forward. Now, before disclosing the name of the stock, very quick disclaimer, I do not want any profits. In case you book any profits, kindly act as per your understanding. If you feel that this stock is good, try to build position, how to build position, etc. I have already taught earlier. Please go and watch some of my videos. But please be responsible for your own money. This is not a stock recommendation. I'm genuinely telling you, and I have been genuinely telling you, whatever I'm doing in the market, I just simply come out and discuss those strategies with you. So please take it as a fundamental research point for your analysis, and then finally act as per your understanding. Okay, so which stock am I talking about and which stock am I going to build my further positions in? So I'm talking about HDFC Bank. I think it is at a great buying level and I'm aggregating more of my position in it. Now I'm going to talk about 6 specific points regarding HDFC Bank stock, and this will help you understand the entire growth story of HDFC Bank stock in a very simple, clear, precise manner. Now, before I discuss these 6 points about HDFC Bank, please read this tweet. This is a very important tweet regarding the devaluation of INR compared to US dollar. This has a lot to do with HDFC Bank. How exactly? I will reveal my answer along the video, but this is a very, very important point that you must understand. This will help you assess the risk profile of HDFC Bank. So I will explain you the entire macroeconomics behind it. Also, a very quick shout out to our sponsors for today, which is Small Case. They allow you to do thematic investment. And in case you do not understand much about stock market and you are struggling to take individual positions in stock, you could consider investing via small cases. I have collated some of my favorite small cases in the description box, and I have also talked about the risk profile of small cases. Please study the pros and cons and then make a call whether you should be investing via small cases or not. So let us get the discussion started. And the number one reason why I am bullish about HDFC Bank is that it is India's foremost bank, and also its lending model is very, very sensible. Now, what do I mean that the lending model is very sensible? So here is a piece of news which talks about how Paytm is giving more and more and more loans, and people are celebrating that, you know what, now Paytm will become like a growth story. It will become like highly profitable. It will just kill Google also, and everything good things are going to happen with Paytm. Why? Because they are able to give out more loans. Okay, so that is just half the story. Once you have given out loans, you need to collect it back also, right? That simple, common, logical sense. That in simple words is the banking model. Now, what do banks do? They take money from depositors and they give out to people who want loans, and in the middle they make commissions. So both the side of the story needs to be sensible. For example, here HDFC Bank is very, very good in terms of taking deposits at a lower rate. The CASA number is one of the numbers that indicates that how effectively a bank is able to procure a deposit. What is it? I'll explain you in a minute. And on the flip side, it is able to lend the money very well to these borrowers. That the borrowers do not default, that is the risk management that a bank has to do. So compare this example to Paytm, that Paytm is being celebrated right now, that they are giving more and more loans. Great, awesome. But is there any history that they are able to give out those loans sensibly and they are able to manage risks associated with those loans? The answer is no. With HDFC Bank, their risk management abilities have been proven. So can I show you some numbers or data associated with it? Absolutely. So let me take you to a financial comparison of HDFC Bank with Kotak Bank and ICICI Bank. And here we need to take a look at gross NPA. Now, gross NPA is a very important matrix. It tells you in very easy to understand words that how a bank manages its risk. That for example, if it has given out 100 rupees of loans, then what amount of loan is being repaid by its borrowers. So in HDFC Bank's case, their NPA or default is only 1.17%. So rest of the money gets paid back to them, which is very good. If you compare it to Kotak Bank or if you compare it to ICICI Bank, that they are not able to manage the risk as effectively as HDFC Bank does. So HDFC Bank has proven time and again that it is a very trustworthy lender and collector of money. So the risk management system of HDFC is very good. Therefore, the bank is very sound fundamentally. Now, why does that happen? Let me know your answer in the comment box. I will put my answer in the pinned comment. So you go, please check the pinned comment. Now, the second key reason why I'm bullish on HDFC Bank is that its stock performance or stock price has been very muted, but its performance or actual financial performance has been very good. Now, what do I mean by that? Let me show you some numbers so you get more clarity on it. So take a look at the last 5-year returns for HDFC Bank. Now, in the last 5 years, HDFC Bank has only given 65.62% returns. Now, you might say that, okay, you know what, if I divide 65 by 5, then it comes out to be 13% CAGR, which seems like an okay return. No, for a bank like HDFC, only 13% CAGR is very, very poor returns. Why do I say it? Because think about it this way, that banking is inherently a very volatile industry. It is high risk. India is an emerging economy, so you should be given more risk premium. And on an average, Nifty gives 12.5%, 13% to begin with. So a bank like HDFC should have given you at least 18-19%. So there is a huge deficit here or a profit-making opportunity here. The last 5-year returns for HDFC Bank has been muted. That is a simple message that I'm trying to give. Now, can I identify that HDFC Bank is undervalued as of now? I would argue that yes. In terms of its financial performance, HDFC Bank's stock price has been muted. And here is why. So let us look at the PE ratio for HDFC Bank. And what you will find is that the median PE for HDFC Bank is 27.2. And what is the current PE at which HDFC Bank is currently trading? It is roughly trading at 20.3 PE. So of course, right now there is a huge PE expansion opportunity also because this is the last 5-year median PE and right now it is being discounted quite a lot. Why is that the case? I will help you understand that also by picking the tweet that I had earlier shown on the video. Now you might say that, you know what, maybe HDFC Bank's performance has not been that great. It's not generating enough revenues, profit. So let us quickly check that also. So if you study the last 5-year performance of HDFC Bank, so let's study it from 2017 right to 2022. So you can clearly see that revenues have almost doubled. There has been no problem in terms of revenue. What about profits? Have profits doubled? The answer is absolutely yes. The profits have almost doubled, right? If you take a look at last 5-year profit growth, the average growth has been roughly 20% CAGR per year. But the stock price growth has been less than 13%. So therefore, according to me, HDFC Bank is an undervalued stock as of now. Now, the third key reason why I'm bullish about HDFC Bank is that its business model is such that it is going to generate even more profits going forward. Why am I saying it? So let me show you some fundamental data. So this is the breakup of revenues as to how HDFC Bank actually makes its money. And you will see that retail banking is one of the most prominent sections through which it is making revenue. So almost 50% of its revenues come from retail banking. Now comes a related point that if 50% of the money is coming through retail banking, then what becomes a very important ratio for something like HDFC Bank? CASA becomes one of the most important ratios. So let me explain what CASA means. So CASA simply means current account, savings account. In very easy to understand language, when you and I go and deposit our money in savings account of HDFC Bank, that's the cheapest source of fund that HDFC Bank has because they do not pay much interest on that savings account. So if this cheap source of fund is widely available to HDFC Bank, it is going to become more and more profitable with time. So we need to take a look at how this CASA ratio is developing at HDFC Bank. So let me show you 2 more data points. So this is the last 5-year chart for HDFC Bank's source of funds, and you can clearly see that savings deposit has gone up quite a lot, term deposit has gone up quite a lot, and you can see the width of these green candles. It shows that major growth in terms of the deposit has come from these two areas, and these two areas are cheapest source of fund that a bank can have. So they are doing fairly well when it comes to accessing these cheap deposits. Now let us compare it with other banks. Now what you will see is that this is a comparison between HDFC Bank and ICICI Bank CASA ratio. And if you compare the performance in the last 5 years, so at one point in time, the CASA ratio for ICICI Bank was much better, and then it started to go down. And now the situation is that the CASA ratio for HDFC has become much stronger with time. So at this stage, I feel that HDFC Bank is a better buy compared to ICICI Bank. Now comes the fourth point as to why am I bullish on HDFC Bank. The story here is fairly simple, that in a downturn, the monopoly companies actually tend to perform better. This becomes like a massive business building phase for these big companies, and HDFC Bank is one of the biggest companies or one of the most trusted companies in India, so to say, and they are going to benefit a lot through this pandemic, through the current crisis that we are going through, and they are going to improve upon that business. So this is called as the survival of the fittest in very simple terms, and it plays out in the business world also. So what happens in the downturn of an economy is that many average or bad businesses, they die. And this includes bank also, this includes BNPL companies also, this includes several lenders also. So these companies are going to die, and guess which company is going to pick up their market share? It is going to be HDFC Bank. Now let me take over to one of the old interviews of Mr. Aditya Puri, and this is what he had to say about the brand building initiative of HDFC Bank. This is a very important commentary.
That when you talk about fintech, what about the trust of the brand?
Yeah.
So if you see, most of the studies say that if you can provide even 90%, we want to provide 110%. If you can provide even 90% of what is coming up as the new products and customer convenience, then your trust and your knowledge and your distribution and your customer base should keep you ahead. Two things that will happen which should be understood. The race for people like Amazon and the others is to get the customers. Because they have the product. And for us is to get the right product and operating system in place because we have the customers.
So as per this clip, it is very clear that HDFC Bank has a brand. They already have customer. They just need to solve the engineering problem of building products and selling it to their existing set of customers who already trust them. This becomes like such an easy thing for them to do. So you'll say that, okay, why is it that HDFC Bank was not doing it up until now? Why did BNPL companies come into picture? Why do these other set of companies came into picture? Why? Because HDFC Bank is fighting a lot of battles. They are trying to increase their village penetration, tier 2, tier 3 city penetration. They are trying to focus on their infrastructure, whatnot, right? So there are too many battles that they are fighting. So now what has happened is that in the last 2-3 years, a lot of innovation has come in the fintech space. There are new age fintech companies, BNPL companies that have created newer markets. For example, take like instant loans, whatnot, right? So as a result, what HDFC Bank can now easily do is that they can figure out which pockets of this economy is going to make sense for them. So they are going to develop their product lines accordingly. And they already have set of customers. They already have brands. So how difficult do you think it will become for them to go and explore this route? Not much difficult, and they are already doing it. So for example, you might have seen something called as Pays app. It is backed by HDFC Bank, and they are going to focus even more in terms of strengthening this product and launching similar products in the market. Now, another related systemic point here is that RBI is not very warm to these new age fintech startups. They have been after the lives of BNPL startups. They are now after the lives of a lot of fintech companies. They have withdrawn the licenses of really big players in the market. They have not given banking licenses to a lot of players. Now, what is exactly happening and why is it that RBI is so scared to begin with? Point number one is that we are still in a downtrend of an economy where the entire credit lending space is shrinking, so to say. So RBI wants to be conservative in its approach. Conservative simply means they simply want to be cautious in the economy, and therefore they are not giving excess banking licenses and promoting like BNPL and all that stuff. Who do you think is going to benefit? Already established player. And guess which is the most established player in the fintech domain? It is HDFC Bank. So from that particular perspective, it's almost given that HDFC Bank is a very, very strong stock at the moment. Is it a recommendation from my side for you to buy? Absolutely not. Please do it as per your understanding. HDFC Bank stock can fall also. So please do not ask me that, you know what, Akshat, why is HDFC Bank falling this, that? Please do your own due diligence and analysis. Now comes fifth macro point that I would like to draw your attention to, and take a look at this chart. This shows the flow of domestic credit as per percentage of GDP over the last several years. you will clearly see an upward moving trend here. Why is this happening? Because number one, more governments are printing more and more money. That game is never going to stop. It's plain and simple. We have already entered into that trajectory. Probably I'm going to make a video what is the negative side of that equation, but to cut the long story short, the credit flow in the economy is improving, especially in a country like India. Is it a good sign? It's a much more complex topic, so I'll cover it on some other video. But yeah, with the improved flow of credit, what ends up happening is that banks become more and more profitable with time. So this equation is not dying down, that more governments are going to print even more money, that banks are going to play even more prominent role in terms of disbursing this credit growth. So banks become a prominent channel. So therefore, there is no other option but for an economy to grow, its banking industry has to grow simply because of this chart. So I hope you get the picture why banks are very important, especially in an environment when the governments are pushing more and more money out. Now, the good thing about India is that India is very sensible when it comes to taking debt. Now, this is applicable even at a government level and also at a household debt level. So here is the household debt level data. What you will find in the US is that it is almost 100%. Every person owns like 5 credit cards. They are taking like 20 EMIs on everything, and it's just madness there. But in India, people are sensible when it comes to spending, when it comes to saving. So yes, this situation is changing, unfortunately, for the worse. But as of now, our debt on the household is not as high compared to some of the other countries, which is a very good macro factor, and it makes India one of the strongest emerging economies in the world. And definitely with the growth of the economy, it has to be supported by banks. So therefore, HDFC Bank becomes one of the most prominent banks that can foster this growth. So now comes the sixth and final point, which is around the operating matrix of HDFC Bank. So let me show you one by one. So first comes the market share, and you can clearly see that HDFC Bank has been going up. There has been no problem there. Now let us take a look at the bank deposit. That okay, fine. More market share is being captured, but are people actually depositing money? Because that becomes a fodder for the bank to run its business. So getting deposits is one of the critical things for any bank. So let us see if that is going up. So yes, again, so there has been very clear uptrend in this domain as well. So no problem there. So what about CASA ratio? And you can see this from the black line. You again can see that HDFC Bank, the CASA ratio has been going up. There has been no problem there. So now let us quickly study the technicals of HDFC Bank also, and let's see if there is any short-term or mid-term growth opportunity in this stock. Now a lot depends on the market circumstances, because if the markets go into another round of consolidation or correction, then of course something like HDFC Bank is likely to fall. Why? Because it's in banking. Banking is a volatile sector. It's a growth sector. So of course it is going to get hit a lot. But if the markets start consolidating at this point, or if it starts giving an up move, then something like HDFC Bank, and especially the banking sector from this point, it is going to give very good returns. So let us quickly study the technicals. There are some good technicals forming here. So this is more like a reverse head and shoulder, and it gives a very easy technical target of up till its 200-day moving average. So this gives you a gain of roughly 8%. There is significant margin of safety that is already there for the stock because it has fallen quite extensively from its peak. How much from the peak? So let me just quickly tell you. So right now it is trading at roughly 16% discount from its peak. So I'm quite bullish about it. Now, what is the risk in terms of buying HDFC Bank? Very quick commentary there, and I will take you back to my tweet. Now, the major risk for HDFC Bank actually does not come from India. It comes from the US. This is the 2008 story, and you will see that in roughly 2008, 1 USD was equal to roughly 43 Indian rupees. Now, in 2022, 1 USD is equal to 80 Indian rupees. Why such a difference? Because if you think about it, that US has printed more money. There is so much negativity in the US. Politics is going haywire. People and kids are actually buying gun and doing violent stuff with it. So why is it that India is suffering but US to that extent is not? The reason there is that US dollar is the apex currency of the world. Now, whenever the US Feds or US government decides to print more and more money, it is the emerging economies that suffer the most. Why is that? There are two reasons. First and foremost, almost every single currency on earth right now is pegged to the US dollar, so to say. There is very strong linkage. Number two thing is that with every US Fed action, the risk on the world increases. Every time the US decides to run the printer, it not only destabilizes the US, it destabilizes other emerging economies also. Unfortunately, when the entire risk for the world goes up, guess which parts of the world suffer the most? It is unfortunately parts like India. These are promising economies. They are emerging economies. They had been doing exceptionally well. They have very high population, need for growth. All that stuff is there in India. But with every excessive money printing move that US make, actually India suffers more, or emerging economies suffer more, because the entire risk in the world goes up. So as a result, people flock where? People flock to least risk countries. Think about it this way, that if there is an alien attack that happens on Earth, then where would people want to be? Most likely they would want to be in the US. Why? Because US has military might. They might be able to handle the situation better. And keeping the nationalistic pride aside, I'm sure that all of us would agree with that answer. Same happens with financial attack on the world. That if there is financial attack on the world, that the increasing debt is there, increasing destability is there. Whether it happens due to India, China, US, it doesn't matter. But as long as the world suffers financially, emerging economies, especially the growth economies like India, are going to suffer the most. And even in India, sectors like banking and finance are going to suffer the most, because they are the most volatile sector. So HDFC Bank's risk does not come from India's actions, it comes more from the US's action. Is there anything that we can do? The answer is no. You need to make your own call, whether you should be investing, not investing in it. But I hope you enjoyed the video. Please press the like button and I will see you soon.